Welcome back, best ever listeners, to the Horizon Podcast. I'm John Chang, and as most of you hopefully know, I've been active in real estate investing most of my life, and since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, as I do each week, I must mention that I am doing this podcast independently, and what I say on this show doesn't reflect the opinions or positions of Marcus & Millichap. So as I get started here this week, I do want to ask you to do me a favor. Please like and subscribe to my podcast so you can stay in tune with what's happening in commercial real estate. Much appreciated. Now, this week I'm going to share with you the one big reason I believe commercial real estate is positioned to outperform over the next 5 years. There's a big picture force that is going to shape commercial real estate, and that thing is government policy, specifically two signature policies of the Trump administration. Whether you love him or hate him, it doesn't matter. The policies that are in place and they're activated already will have a significant structural change on commercial real estate as we know it. And over time, these policies will drive up property values, in my opinion. So the first one is tariffs. You probably already guessed that. But the why and how matters. So earlier this month, the tariffs on steel and aluminum were increased from 25% to 50%. Now, think about that for a minute. How much steel and aluminum is used in commercial real estate construction? Apartments, garden style apartments, not so much, although you'll get hit with things like higher cost of HVAC and appliances. But for, say, self-storage, there's a lot. The steel doors, the roll-up doors in the storage units. If you look at a commercial building, an office building, or a retail center, you have steel framing and I-beams and the HVAC systems and so on. And all of those prices are going up. Last month, the price of aluminum went up by 2%. In that month, in 1 month, the price of aluminum went up 2%, and the price of steel went up 5%. So if you think about how that affects the cost of construction, it's pretty significant. And if you look at how that carries forward into the future as these tariffs really come into play, because we haven't fully seen the impact of the tariffs yet. Literally, those tariffs on steel and aluminum were just put in place, I think, on June 4th. So we won't see the true effect of those until probably September, October, when the current supply that's already been purchased has gone through the system and we're starting to order new supplies. So if you think about this, it's pretty significant. Input prices are now, for construction, are now 1.3% higher than a year ago overall, and 1.6% higher for non-residential construction. And tariff-related price increases beyond steel, aluminum, overall are going up faster than declines in energy prices were going down. So on an annualized basis, I just saw this in the news, costs for construction climbed by 6% in May. And that's an annualized rate, but I think that accelerates because that's a 6% increase in May annualized basis. That's not a nominal change. That is the annualized rate of increase. It was 6% in May, but that's before the steel and aluminum tariffs doubled. On top of that, Canadian softwood lumber, which is used heavily in multifamily construction, especially garden style apartments, the tariffs on Canadian softwood lumber, which is about 30% of the lumber that is used in construction, is the tariffs on that is currently 14.5%. I've seen predictions pushing that tariff rate up to around 35, maybe even 40%. And I saw that was targeted, not scheduled, targeted for September, which means we'll see those cost increases roll through late in the year, probably December or January of next year. So you have these huge increases in the cost of materials that are going to ultimately impact the cost of construction. And so really what that does is it reduces the amount of construction that you're going to put in, and that rejiggers your new supply math on your supply and demand metrics. The second policy coming into effect, that is another signature of the Trump administration, and we're seeing it in the news a lot, and I've talked about it a little bit over the course of the last few months, but it is deportations and immigration policy. Now, set aside deportations and strictly look at immigration policy. It's not just about illegals. This is having a chilling effect on legal immigration to the United States just as much as it is illegal immigration. But officially, about 34% of construction workers are non-native born people, theoretically with a green card or a worker permit that allows them to work. But unofficially, I've heard numbers as high as 50, 60, even 70% of the work crews are immigrants. And so that is a big percentage if you think about how the labor market would react to significant reductions of not just illegal immigrants on the construction sites, but legal workers as well, if we reduce our legal immigration to the United States. And I want to point out, during Trump's prior administration, where the enforcement was not nearly as aggressive as it is this time, we saw a significant reduction in immigration to the United States. It was down by 40, 50% over the course of his administration. And that's not counting 2020 when COVID was coming into play. So we could see a dramatic reduction in immigrant workforce coming into the United States, which puts a strain on the labor supply. Now, when you break it down, and this is according to, I think it was the National Association of Home Builders, the share of immigrant labor focused on specific parts of the construction process varies, of course, with plasterers and stucco masons, as well as drywall and ceiling installers, constituting the highest share of immigrant labor. That's at 61%. Roofers, 52%. Painters, 51%. Carpet, flooring, tile installers, 45%. So when you get down to the nitty gritty of building a commercial real estate building, you're going to have a huge impact on labor availability as well as labor cost. So currently, construction labor costs are going up by about 4.3%, which is one of the higher sectors of employment in terms of how much the labor costs are going up. And in 2023, construction labor costs were rising at 5.5%. But if we are reducing the number of skilled construction workers in the country, we could see a even more dramatic increase in the cost of construction labor. So as a result, that's going to put a chilling effect on the pace of construction. We will see a dramatic drop off in the development of new units of apartments. We'll see a dramatic reduction in commercial space construction. And as a result, the supply and demand balance will get shifted. We could see an increase in construction costs by 10% or more over the course of the next year or so. And over multiple years, that is going to compound to a degree. Now, granted, if we see the construction, the tariffs on materials stabilize, the upward pressure will slow down. Maybe we get a 10% lift in the next year, and then maybe it stabilizes at the new level, maybe only going up 5% or something like that in years following. But nonetheless, we're still seeing that upward momentum in the price of construction. And that reduces the new supply coming online. And as a result, your supply and demand dynamics get shifted over time. So when you look at a lot of these metrics, you look at vacancy rates, you look at pricing models, we're already, because of the price corrections of the last couple years, we're already seeing a reduction of values that put new units or put the purchase price of commercial real estate in many cases below replacement cost. And as replacement costs rise because of those construction cost changes, then that differential expands even more. And eventually what's going to happen is it's going to pull up the prices on existing properties. But not only that, you're also going to see accelerated rent growth because of shortages of available space. That means we'll see apartment vacancies come down. We're expecting them to hit 5.1% this year, but we're seeing a dramatic reduction in the pace of apartment completions over the course of the next couple of years. I think the number of starts is down by, 73%. And the number of project under construction, starts are down 76%, sorry. And the apartment units under construction are down 46% from peak, and the peak was in 2022. So we're already seeing a downturn in the apartment construction sector. And as a result, that supply challenge will get even more dramatic over the course of the next year, 2 years, 3 years, 4 and 5. And as I always say, you always have to think about the long-term trend. Okay. Now, because President Trump has a 4-year presidency, I don't see these policies changing dramatically over the next 4 years. These are policies that he hung his hat on. And so I don't think this changes. That means 5 years from now, as these issues compound, the performance of commercial real estate, and it's pretty much all types of commercial real estate, will improve. The vacancy rates will come down. The rent growth will accelerate. I think we'll see it mostly in apartments. We'll also see it in retail. Construction of retail has been very limited for the last 20 years or so. But I think that it slows down even more as we go forward, and as those costs increase. So retail vacancy rates, which are already low, about 4.6%, will get even tighter, depending on, how businesses do and what happens with the rest of the economy. So you're going to see it in multifamily. You will see it in the retail sector. Office is a little bit different situation because office vacancies, as everybody's well aware, are quite high, up north of 16% right now overall. As we see more and more people in the workforce returning to the office, the demand for office is expected to recover. I think we've had 4 quarters of consecutive positive absorption for office, and that trend should continue. It's not huge movement, but it is still positive momentum. And there are some markets, and I've mentioned this in the past, like Las Vegas and Miami, where the vacancy rates are still at or below where they were in 2019. So we could see continued momentum in those markets, but we'll also see strengthening in markets like New York, places that have a lot of aggressive growth, like Dallas, Texas, could see improving vacancy rates. And since we're not going to be building any more office to speak of, then that trend continues to strengthen over time. And remember, the cap rates on office buildings are higher than most other property types. We show a national average cap rate for office somewhere around 7.9%. That's overall. Now, there are buildings that are being sold at a massive haircut reduction. I saw in the Wall Street Journal this week that Big Pink, an office tower in Portland, Oregon, is being sold at an 80% discount. It has a huge vacancy problem. That building was an icon in Portland at one time, but has since underperformed, and downtown Portland's been challenged. But over time, over the next 5 years, we could ultimately see markets like that turn around. We could see those office buildings improve. Now, are they going to get great? Are we going to see, 90% occupancy rates? Yeah, probably not. But if you're buying it at a massive discount and you have the resources to upgrade the facilities, improve the building, and you have the ability to attract tenants because you are a seasoned operator, then you could build momentum on that, and you're buying it at an elevated cap rate. I don't know what the cap rate is on Big Pink in Portland. Presumably it's quite high, but I think its vacancy rate is like 80%. So, that's a complete turnaround model. Anyway, I'm kind of running down into a rabbit hole here, but nonetheless, you look at the vacancy rates in office relative to the cap rates, and there are opportunities for seasoned operators to improve that. Industrial is another one where we have a supply overhang, especially in major port markets as well as distribution hubs where there's been a lot of construction. I'm talking about Riverside, San Bernardino, or the Inland Empire, Phoenix, Dallas, Atlanta, Chicago, Houston. I think Indianapolis is up there right now. But these are all markets where there's been a lot of big box industrial space added, and we're seeing a lot of vacancy there. But that pace of construction for industrial properties has come down pretty significantly. Let me take a peek. I'm just looking at the pace of construction for industrial. In 2023, we developed about 530 million square feet of industrial space in the U.S. This year, we're looking at less than half that, 250 million. And as these construction costs continue to rise, that supply overhang and the pace of construction will slow down, and those vacancy rates will start to turn around. Right now, we're showing a 7.6% vacancy rate for industrial. That's our forecast for 2025. And again, as we go forward, I think absorption will recover for industrial properties, and we're going to see a little bit more momentum there. And over the course of the next 5 years, if construction continues to taper, then we get back into a low vacancy rate scenario. And remember, just a few years ago, right, in 2022, we had a vacancy rate for industrial of 3.7% and massive rent growth. So when we see these vacancy rates get way down where the market becomes super tight, you get into a situation where you see double-digit rent growth. And when you get to double-digit rent growth, that drives property values at an accelerated pace. So we're not even just talking about, hey, you could buy a building for cheaper than construction, than replacement cost today. But over the course of the next 5 years, as the supply pressure is depleted, then you get to see a demand model that really overpowers that supply. And you start to see really dramatic increases in rent, which drives the profitability of the asset, which in turn multiplies out into a much higher commercial real estate price. So this is going to affect all types of commercial real estate. This isn't just any one particular property type, because the drivers that is going to move all of these things is structural in nature, and it's going to impact all construction, even the single family housing sector. If you look at the National Association of Home Builders sentiment survey that just came out this last week, builder sentiment is exceptionally low. It's been falling very rapidly. They're feeling the pain. They're upset about the rising construction costs because it is making the already expensive housing market even more expensive. When you look at the cost to purchase a home, and I'm talking about a median priced home, not just, not a fancy millionaire mansion. I'm talking a median priced home in the United States is $413,000. Okay. Assuming a 10% down payment, we've modeled in taxes, insurance, and mortgage insurance, and all of those expenses. The payment on that house is about, based on our model, $3,163. And at that price, only about 26% of American households can afford it. Now, when you change that over into a newly constructed home, the market of opportunity is even smaller. And as a result, the home building industry is facing additional risk. So anybody who makes their livelihood from construction is definitely facing an uphill battle over the course of the next 4 years because of the labor shortages, and because the cost of materials are climbing, and because it's just not going to pencil. That doesn't even factor in the other dimension, which is the cost of capital. Construction loan rates, I think they're somewhere around 8% right now. And if you've heard some of my other podcasts, the interest rate pressure over the remainder of this year and into next is upward, in my opinion. And that's driven by the issuance of treasuries and the limited pool of buyers for those treasuries. So, certainly the rates probably will not go down. And if I was going to place a bet, I would put it on the cost of capital, debt capital going up. So in my opinion, you can do with it what you want, but in my opinion, commercial real estate is poised to outperform over the next 5 years because of these policies. Is that on purpose? I don't know. Doesn't really matter, right? It's not about whether we're doing things on purpose or not. It's about what are the forces that are going to affect the industry. And on a big picture level, on a macro basis, the forces affecting commercial real estate supply and demand are going to be increasingly favorable because construction costs are going to go up. And that is both the labor costs as well as the material costs. And that's going to limit the supply, assuming demand is sustained. And I don't see any reason why demand would not. Yes, we're going to have deportations, which should theoretically reduce the demand for certain types of commercial real estate. And there will certainly be pockets that will feel the effect of that. But in general, in mass, across the United States, the housing demand, the retail space demand, the industrial demand, the office space demand should all gain momentum over the next 5 years. but there won't be a new supply. The new supply will be limited, and that will drive down the vacancy rates. So, I'm going to put a wrap on it there, actually. I think I'm going to be a little bit shorter this week, but there you go. That is my big thesis on why two of President Trump's signature policies will bolster the performance of commercial real estate over the next 5 years and increase commercial real estate property values. So I want to thank all of you for joining the Horizon podcast today. I will be back next Sunday and every Sunday with my real estate insights for whatever they're worth to help you understand what's really going on in commercial real estate. So I'll see you next week. And now you know why I always say, keep your eyes on the horizon.